billion quietly walked out of New York in June 2025, boarding a northbound train with no return ticket. Picture a closed-door suite in downtown Toronto. No Goldman briefcases, no JP Morgan lapel pins. Only the muted click of Barclays laptops and a dossier stamped Ontario Sovereign Bond, $2 billion US. The deal feels less like finance and more like a protest etched in ink and basis points. You can almost see Bay Street's sly grin. If Washington taxes our steel, we'll tax its pride. So ask yourself, when allies start funding their future without America, how long before the balance sheets turn into ballots against the man in the White House? February 2025 felt like a steel door slamming shut. Washington slapped double-digit tariffs on Canadian steel, auto parts, even circuit boards, then dialed them higher against China 2 months later. Supply chains groaned. Currency desks went on red alert. Ottawa chose silence over slogans. No tariffs, no boycott hashtags. Just a single surgical strike at America's soft spot: capital.
To be able to support Canadians through this challenging time.
If you tax our factories, one Canadian official quipped off mic, we'll reroute your money. In that moment, the rules of North American trade flipped overnight. Ontario's Treasury officials entered the market on June 9, 2025, with a 10-year US dollar bond worth $2 billion, and conspicuously left every American bank off the syndicate. Barclays plc steered the deal alongside homegrown titans CIBC, BMO Capital Markets, and Scotiabank. It was the first time since July 2011 that a greenback issue from Canada's largest province carried no Goldman, no JP Morgan, no Bank of America. Bloomberg's Chunzi Shu called it a watershed that erased almost 14 years of quiet habit. The motives ran deeper than routine bookrunner rotation. At Queen's Park, senior advisors framed the move as a measured retaliation against Washington's February steel and auto tariffs. If the White House taxes production, Ontario will tax prestige. By inviting Barclays to headline and leaving New York's bulge bracket outside the glass doors, the province signaled it can raise dollars without America's blessing, while simultaneously strengthening ties with post-Brexit London and its own domestic lenders. Wall Street felt the sting. For decades, U.S. banks dominated Canadian dollar and U.S. dollar issuance, pocketing fees and shaping pricing conventions. Now, one veteran syndicate manager admitted off-record, "We've moved from first call to afterthought." Ontario's financing authority says up to 30% of its projected $60 billion borrowing. This fiscal year may now route through non-U.S. channels, capital that once padded Manhattan ledgers. Beyond fees, the long game is influence. If provinces can syndicate abroad, they can benchmark to the ECB curve instead of the Fed, gradually decoupling swap lines, collateral norms, even political leverage. Canada hasn't declared financial independence. It simply erased the United States from the prospectus footer, one bond at a time. If Ontario's snub stung Wall Street, Alberta's response felt like a cold front sweeping straight through the canyons of Lower Manhattan. On 26 March 2025, the oil-rich province tapped the euro market for 1.25 billion euros, about $1.35 billion, in 10-year notes. Barclays, Royal Bank of Canada, and TD Securities steered the book. Bank of America and every other U.S. heavyweight were missing for the first time since 2019. Canada could boost oil supplies to U.S., but also needs new markets, Alberta Premier says. Why Brussels, not Broadway? Premier Danielle Smith framed it as energy insurance, diversifying Alberta's crude lifeline just as Washington's tariff salvos made every pipeline permit feel like a loaded gun. At CERA Week, she hinted that new barrels would sail west to Asia and south through the Gulf of Mexico, routes now underwritten by European banks more eager to price carbon than politics. The Euro deal did more than raise cheap cash. It benchmarked Alberta's credit to ECB yields, bypassing the Fed's policy gravity. Hedging desks in Frankfurt now quote CDS spreads for Edmonton exporters, while Alberta Treasury Board analysts openly model bond swaps that never touch a U.S. swap line. One London trader put it bluntly, if you clear billions in euros, you start dreaming in euros. In short, as Alberta's crude cargoes change oceans, its balance sheet changes currencies, diluting Washington's leverage one tanker and 1 basis point at a time. Alberta's Eurobond did more than tweak currency risk. It nudged the entire Canadian system toward a new compass point. By late April 2025, the IMF flagged unusually tight U.S. dollar funding conditions for non-U.S. banks operating in Canada, especially on the West Coast, a stress level last seen in the late 1990s Asian crisis. In Vancouver money markets, overnight swap spreads versus SOFR blew out by 42 basis points in a single week, forcing smaller lenders to scramble for term funding and prompting the Bank of Canada to warn, in its May Financial Stability Report, that an extended tariff war could mutate into a liquidity crunch. The escape hatch opened eastward. Dealers at RBC Capital Markets quietly began quoting 5- and 10-year corporate hedges off the Euribor OIS curve, arguing that ECB guidance, not the Fed's, now set the marginal cost of funds for euro-denominated debt. One syndicate desk in Frankfurt described the shift as pricing Canada off Lagarde, not Powell. Swap traders backed the rhetoric with hard lines. Euro-CAD cross-currency swaps hit a 2-year high in volume during June, according to ECB liquidity line disclosures. The mechanics are simple but profound. Canada still enjoys a standing Fed swap line, yet provincial treasuries increasingly tap the ECB's network, locking in euros that they can flip into dollars later, if and only if the terms favor them. With every such trade, Ottawa's benchmark risk-free rate drifts a hair closer to Frankfurt. The question isn't whether Canada can live without the Fed. It's how long before bond investors, too, start scanning ECB press releases before they bother reading the FOMC minutes. Ontario's rerouting of capital is already rewriting factory blueprints. The province projects 59.8 billion Canadian dollars in fresh borrowing for fiscal year 2025-26, and Finance Minister Peter Bethlenfalvy says as much as 30% will come from foreign markets. That means billions in plant subsidies and road upgrades for Ford, GM, and Honda will be priced in Frankfurt, not on Wall Street. European lenders arrive with a different calculator. RBC Capital Markets Sustainable Finance Themes. 2025 notes that over 2/3 of European asset owners now embed ESG screens in more than half their portfolios, and that responsible supply chain funding is a top 5 priority for the year. In plain language, loans are cheap only if the assembly line is clean. Hybrid drivetrains that still burn gasoline struggle to clear those screens. Fully electric or fuel cell projects sail through. The tension is already visible on the shop floor. In May, Honda froze a planned US $15 billion EV and battery complex in Alliston, citing trade turmoil and funding uncertainty. Without Washington's tax credits or Wall Street's syndicate fees, Honda must court European green bond buyers who insist on tighter carbon metrics than the shelved U.S. Inflation Reduction Act ever required. Ford and GM face a starker choice: retool Ontario lines for zero tailpipe models that satisfy EU capital, or watch cheaper Chinese EV platforms slip into the gap. One Detroit executive, granted anonymity, put it this way: your cost of capital is now determined by someone reading an ESG dashboard in Paris, not a risk model in Charlotte. In short, the tariff fight pushed supply chains out of alignment. Europe's climate bankers are locking the gears in their new position. The policy shift crystallized in a single, emotionally charged speech. Standing before business leaders at Toronto's Canada Growth Summit, April 24, 2025, Premier Doug Ford warned that Donald Trump was trying to wipe out our auto sector and take over Canada, adding a line that ricocheted across trading desks. "We're finished playing by his rules." Ford's words landed less like a soundbite, more like a bond market bulletin. Only 10 days earlier, Finance Minister Peter Bethlen-Falvey had called Trump's tariffs a wake-up call that demanded sovereign financing tools outside Wall Street. Together, the two statements drew a bright red circle around Ontario's bond syndicate decision and Alberta's euro debut. These were not technical adjustments but political lines in the sand. Traders read the message fast. Within 48 hours of Ford's address, Ontario's 10-year Yankee bonds widened 7 basis points versus U.S. Treasuries. Small in retail terms, huge in the algorithmic world, where spreads move on nuance. Dealers in London joked that the real risk-free rate north of the lakes now depends on Queen's Park pressers. Just as crucially, Ford's phrasing gave corporate boards air cover to pivot. When a premier publicly declares independence from Washington, an auto CEO can cite strategic alignment with provincial policy as a reason to chase Frankfurt's green money or reroute lithium contracts through Jakarta. That moral license, not the 7-point spread, is what truly rattled White House trade advisors and set the stage for the next volley in this financial divorce. With Wall Street sidelined, two rivals are already auditioning to bankroll Canada's next chapter. Europe looks like the obvious heir. Ontario's January 2025 Green Bond deck quotes the EU taxonomy word for word. Part of the sales pitch that moved 1.25 billion Canadian dollars in minutes to desks in Frankfurt and Paris. Behind those orders sits the European Investment Bank, which has lifted its 2025 lending ceiling to a record 95 billion euros. Brussels is dangling still more carrots. A €3 billion battery value chain program that promises ultra-cheap loans for cathode plants, so long as they hit circular economy targets. Yet China refuses to leave the table. Even after Ottawa's tighter security screen, Beijing-linked miners quietly secured fresh Canadian critical minerals assets late last year. Globally, Chinese firms just logged their busiest season for overseas mining deals since 2013, hoovering up lithium, cobalt, and rare earths needed for every EV battery. Control of those inputs would let Chinese traders squeeze the very supply chains Europe hopes to green finance. The contest, then, is less about who underwrites the next provincial bond than who drafts its covenants. Europe offers low coupons but hard ESG riders, no hybrids, audited carbon footprints, transparent sourcing. China offers metals, cheap equipment, and breakneck timelines at the cost of strategic ambiguity. For Queen's Park and Edmonton, the choice is messy: align with Brussels and inherit Europe's slower growth, or dance with Beijing and risk trading one dependency for another. What is clear is that every euro raised and every ton of lithium contracted enlarges the space Washington once occupied, and no tariff can easily reclaim it. North America's balance sheet is being redrawn in real time. If Brussels keeps supplying cheap, green capital, Canada may slide into Europe's regulatory orbit. If Beijing secures lithium and rare earth lifelines, Chinese leverage will extend far beyond raw materials. And should Washington answer with tighter tech sector oversight, the battlefield could shift from tariffs to software and semiconductors. The question lingers. When capital deserts New York, can U.S. political power still command the assembly lines of Ontario?